sorry, recording. For those of you who are just joining us on the recording, I'm starting 3 minutes late, so I'll update you later. Okay, so I know for those of you who are listening in, the losers in the portfolio are a huge source of stress and focus for you. I frequently liken this to a family where if you have a couple kids or a few kids, you know, the 2 or 3 good kids in the family who are doing well in life and okay, kind of get shuffled off to the side, and then the problem child gets a disproportionate amount of attention, even though one should remind themselves that the kids who are doing well really are equally important and viable and validating. But with that in mind, we're going to acknowledge that there's a lot of stress on these companies that have been underperforming. Sorry, I have so many sheets. So since March 18th, we've had 7 companies in the portfolio that we've really worried about. And we've been through this week after week, so you know who the ones that we're not worried about are. You know that we're not worried about AT&T and AbbVie and Pfizer and IBM and Hannon Armstrong and companies like that. Those we're fine with. But there have been the 7 that we have worried about. And those have been Sabra, Ryman, Six Flags, Targa, Ford, Tanger, and Gannett. To give you a little bit of perspective on these, since March 18th, Sabra's up 106%, Ryman's up 143%, Six Flags is up 37%, Targa's up 65%, Ford's up 10%, Tanger bottomed later than the rest, but from its bottom, Tanger is up 35%, which leaves Gannett. Gannett's the only one in that group that was down from that time. We have done a tremendous amount of work on Gannett. We spoke to the management again this week. We worked on it last week. We worked on it more this week, and we decided that we don't think that there's significant upside given what the risk is to the downside at this point. There's just not visibility. There is transparency. The company's been excellent and transparent and super responsive, but with respect to the visibility for that company, we can't see it at this point. So we did sell Gannett yesterday. Okay, but the other 6, Sabra, Ryman, Six Flags, Targa, Ford, Tanger, we're working out of carefully. And we're working out of them carefully because we know that even though they're the worst in the portfolio, there's no risk of insolvency, they have excellent assets, and there should be more upside after this. And we do not want to be the suckers who sell out of fear or out of panic. We want to be smart about our sales and continue to capture those upsides, which we think even after the big moves that I just mentioned, there might be more to come in terms of that. One bit of good news, hold on, someone's trying to chat. Let's see, what's this? Yes, someone just asked me working out of Sabra. So on Sabra, no, actually, as of last week, we've decided we're not going to work out of Sabra, and this is a bit of good news, which is a nice surprise. So Sabra's actually come off the list of companies that need to be sold. And the reason for that is that we had spoken to the CEO a couple times. He told us, look, I am going to need to cut the dividend. When I do, I will do it as much as I need to so that it never needs to happen again, no matter how much worse this gets. And after that, I'll try to bring it back up to speed. But even after speaking to him about that, I had still thought that the dividend cut would be so significant that we would need to sell it, that it wouldn't be worthwhile holding. In fact, they did cut it. They didn't cut it nearly as much as I thought. They cut it from 45 cents a quarter to 30 cents a quarter. It left it at that point in time. Now it's lower because the stock's up so much, but at that point in time, it still had a 13% yield. I know this company well. I know their assets well. I know the CEO well. I trust the CEO. We've been invested for a long time. And when he says we will get we'll get this dividend back up as quickly as possible, I'm quite certain that he will. Okay, next up on that list is Ford. So that'll be the next sale. And we need to have that happen before April 15th, because what we'll be reinvesting the proceeds from Ford in will be Compass Diversified. We'll be increasing the position there. And Compass Diversified goes ex-dividend, which is something we talked about in our letter from last week. They go ex-dividend on April 15th, and we want to be in that stock ahead of April 15th, so we're able to capture that dividend. So we'll use the proceeds from Ford for that. We'll also increase our positions in Enterprise or ONEOK, depending on which one you own based on K1s or not. And then after that, we will increase Navient. The next sale after Ford will be Targa, but there's a lot of potential upside still in Targa, especially after we get news from the OPEC meeting that's scheduled to take place tomorrow. And hopefully we see continued upside on oil prices that supports all of the energy. Okay, so went over that. Another quick thing. Last week I got some pushback from some of you because I've been very carefully adding 2 positions that are underweight. So last week, many of you might have seen that we added to Dow, Magellan or Williams, PacWest, and Hannon Armstrong. This is a volatile market. I am not going to nail the bottom on, hang on, we got one more person. We've got, I'm not going to nail the bottom on the portfolio. Sorry, there we go. I'm not going to nail the bottom exactly right on when I'm adding, but I know that I'm directionally right because I know these companies, I know what their values are, I know what the safety of the dividends are. So the companies that we added to last week, I just wanted to bring this up to give you guys perspective. Right after we added to them, many of them went down significantly. I can't get the day right, but I can get the direction right. With a little patience, here we are a week later. Dow's up 13%, Magellan's up 4%. This is from where we added last week. Williams is up 7.5%, PacWest is up 2%, and Hannon Armstrong's up just shy of 5% right now. So, so please be patient, but we will keep adding, we will keep upgrading the portfolio, increasing the yield, and getting out of the losers that we still need to. Okay, let's see. Some good news from the companies that we hold. Both Compass and AT&T put out press releases this week, confirming that their dividends are totally safe and that they will be paid out. So that's always good to hear. We spoke to the management of Navient again this week to check in. Business is fine. The dividend is safe. They do not expect significant increases in student loan defaults. And again, low interest rates are directly beneficial to that company. So all is well there. Also, JP Morgan just put out a quite strong note on General Motors this morning, it's trading at about 23 right now. They gave it a $37 price target and are quite positive on the overall company based on their inventories, based on their cash position. So that's another one where it's nice to hear good news on. AbbVie and Western Digital, these are companies that we added last year. We initially added AbbVie around 77, increased our position around $67 a share. I think that was May and June. That's finally come back up. So now we're positive on our investment there again. Western Digital, which we added last January at about 37, is back up again, and now it's trading around 43. So it's nice to see some of these companies in the portfolio that were just smashed over the worst of March. It's nice to see them starting to come back up and in their keep. I'm gonna turn it over to Greg, and he's gonna touch on his portfolios, and then we'll get into news and open it up for questions.
Okay, thanks. On the international income portfolio, we've had a nice rebound since mid-March. As Jenny mentioned, March 18th was the bottom for us. The portfolio is up about 15% in that time, about in line with the benchmark. But I think more importantly is the international has been outperforming the U.S. by about 3% in that time. So we're starting to see some money flow into international markets and has started to outperform. Despite the rebound, though, one holding that we are monitoring closely is Las Vegas Sands. Las Vegas Sands gets over 90% of their profits from Asia, and they've managed to be able to keep their Singapore property open during the coronavirus, and in Macau, which was closed, they've reopened the casinos and hotels in Macau. But the issue they're facing is that the travel restrictions in the region are still hurting demand. We still think there's a lot of pent-up demand. We're just not sure when business will return to normal. The company has been committed to the dividend, but we're watching it closely and may sell if we believe that they're going to be forced to cut the dividend. Obviously, we'd prefer to sell the position before the company is forced to cut the dividend. The news is not all bad from the virus in the portfolio. Just want to give one example of a company that is that may be benefiting from the virus. One example is Zurich Financial. In the car insurance industry, I don't know if you've seen the headlines in the past couple of days, but one of the results of the coronavirus is that people are driving less, and as a result, there are less accidents. So car insurance companies are enjoying some nice profits due to the virus. Zurich Financial owns Farmers Insurance in the U.S., and they have a property and casualty business in Europe as well. Their large annual dividend just went ex on Friday and was up 5% from the previous year. So Zurich is continuing to do quite well, and it's one of the largest holdings in the international portfolio. On the growth portfolio, we've had a really strong rebound since the middle of March. That portfolio is up about 24% since March 18th, and it's close to 10% ahead of the S&P 500. So a really strong rebound after a challenging start to the year. One company we are watching closely is Marriott. It's no surprise that Marriott is going to be negatively impacted by the virus. Our hope is that the rebound will, once things return to normal, business will return to Marriott, and there will be a lot of pent-up demand, and Marriott's strong business model will help them to rebound really quickly. But as we're looking at the impact of 2021, we're realizing that the impact on travel may last a lot longer, into 2021 and beyond. And even at a minimum, the new hotel construction is going to slow down, which is going to make it a lot harder for Marriott to grow. So Marriott may not be appropriate for the growth portfolio going forward. We still think Marriott's undervalued, but could use any additional strength in the market to sell it and buy something with either a higher growth rate or a more certain growth rate. As on the positive side in the growth portfolio, I'll highlight Fiserv. This is one of the largest positions in the portfolio. The Fiserv, they provide software and IT services for banks. Their software is going to be in great need, as banks across the country are trying to roll out the SBA loan programs, which were part of the coronavirus stimulus plan that was passed by the government 2 weeks ago. It's a great example of how important technology is to banks, and this is the reason why Fiserv has been able to grow their earnings double digits every year, because banks across the country need the software to help manage the loan process. For a small.
Yeah, Greg, just tell them about Zelle and Venmo, just so people know what Fiserv does.
Well, they provide software and IT services for banks, so they enable banks, especially smaller ones, to have a technological platform that rivals the big banks. So it's a small bank cannot invest the money necessary to develop software for online access, for banking through mobile or transfers of payments. Fiserv has developed Zelle, which many banks have. Even large banks have Zelle as a way to transfer money between banks. So Fiserv is the key technology provider that enables many smaller banks to operate efficiently, and is an important part of the banking sector. So they should see strong demand due to the coronavirus stimulus plan.
So now I think we'll move on to news. And just one bit of news that's like not really news, but an interesting development is they've decided to allow people not to take their required minimum distribution for 2020. So if you have an IRA and you don't want to take money from your RMD, which forces you to pay taxes for 2020, you don't need to. So for any of you who that makes a difference to or is meaningful to, we can talk about that, not in this call, right? Because this is a personal one-off thing, but I just thought it was something that was interesting. If you don't want to take your RMD, you don't have to this year, which is a nice way to not pay more taxes. Okay, and with that, Greg, on to the news.
As we said last week, I'm going to start with the economic data. As I said last week, the economic data is shocking, but not surprising, and that's the important distinction. So initial jobless claims came out last Thursday. They were 6.6 million new claims last week, which brings the total to 10 million. Tomorrow we'll get another report of initial jobless claims, and the forecast is for another 6 million tomorrow. But again, this is shocking, but not surprising given what's going on. And the market's very good at digesting the news as long as it's not surprising. Mm-hmm. On the policy front, a little bit quieter on the policy front. So the federal government continues to roll out its loans to small businesses, and they're working on adding another $250 billion to the program due to high demand. Mnuchin has proposed this, and they're trying to get it passed through the House and Senate probably either today or tomorrow. That'll expand the funding for a program that allows small businesses to maintain their employees and minimizes the economic damage from the virus. The Fed continues their aggressive quantitative easing. They've bought over $500 billion of assets in the last week. Their balance sheet has grown by $1.5 trillion in the last 4 weeks, and they're continuing to buy treasuries and mortgage-backed securities, and really are instrumental in keeping credit markets working and flowing and allowing most of the financial markets to survive during this challenging time. The biggest news of the week, we feel, is the growing evidence around the world that the lockdown restrictions are working. So I think the biggest example of this would be Italy, where the number of daily new cases of the virus peaked 3 weeks ago. It was March 21st. Cases now are down over 50% from the peak. Spain and Germany have also seen a decline, significant decline in the number of virus cases. And we also are seeing possible declines in the UK and France. As a result of this, Austria, Denmark, and Norway have already announced plans to start to lift restrictions to restore some economic activity. And I think other countries across Europe will follow as the data gets better. Back home in the US, the daily cases and number of deaths are still rising, but there are a lot of positive indicators as well, especially in New York, where new cases are plateauing and the hospitalization rates are falling. Just this morning, Mayor de Blasio of New York City, he announced that they're seeing a lot less patients than they expected in the ICU, and they thought they were going to need 300 ventilators per day, an additional 300 ventilators per day, and right now the rate is about only 100 and seems to be declining daily. But it's becoming abundantly clear that the social distancing and lockdown measures are working. But at the same time, the number of deaths in the U.S. is at an all-time high. But please remember that the deaths are a lagging indicator of the virus, and that we should look at hospitalization rates and the number of new cases as a better sign of how the progress of the virus is going.
Greg, can you touch real quick? So earlier today, Greg and I listened to the American Enterprise Institute weekly call with Dr. Scott Gottlieb, which has been a huge source of information for us. Can you just touch on what he said about the models that last week were saying 240,000 and now what they're saying?
Yes. I'm just finding my notes. There. So the model, and we've seen a lot of headlines from this. Dr. Fauci and the president have been quoting a model the government uses, and a lot of governments around the world are using. And there was a point where the model was predicting 250,000 deaths in the U.S., and that was the point where the U.S. and many state governments extended the lockdown restrictions through the end of April. However, since then, the models are showing drastic improvements. So now the model has only 60,000 deaths, still an alarming amount, but substantially better than the 250,000 it was predicting just about a week ago. So things are getting better. I know it still seems pretty scary out there, but the data is improving quite dramatically.
Thanks, Greg. So, okay, so I'm going to bring it back to just a few housekeeping issues and then open it up to questions. I've got 2 questions emailed already. But one thing on housekeeping is today I've been writing the quarterly market letter for the last couple of days, and we're starting the editing process, so it should go out soon. The one thing, when I start off saying business as usual, the one thing is I would like to not mail that out in hard copy this quarter, so I'm going to email it out. If anyone still wants it in hard copy, please do not be shy to ask me, but I'm not going to do the mass paper mailing that I usually do. That is one thing that's hard for us to manage right now. And the same will go with your quarterly review. So for those of you who get the quarterly review, I'm going to email it to you. Do not be shy to ask me for it in paper, but I'm just going to default to emailing it this quarter. I like writing the smiley faces and the notes and the cheeriness on it. Not much cheeriness this quarter anyway. But I'm going to try to email that. So again, don't be shy to ask for it in paper form. Okay, with that out of the way, I'm going to open it up to questions, but I'm going to answer two first. And I would like to remind you all that if it's specific to your portfolio, if it has to do with the asset allocation of your portfolio, with specific trades in your portfolio, please ask me those outside of this call. Please keep the questions a little bit bigger picture. So one question that we've gotten a lot is, how long will this last, and when will we come out of it, and what will the shape of the recovery be? I kind of think shapes of recovery are stupid to over guess at, because nobody knows. But it does seem like for the last couple weeks we've been in a bottoming process, and that we're starting to come out of that. I think because we underperformed the broader market, it really looks like we're starting to make up some of that loss now. Even today, we're up pretty significantly more than the market. So I see us recovering nicely, and I think we're on the mend. But I don't know how long that'll take. One of the calls that we listened to, or Greg listened to the other day, they had a really good phrasing, and they said, this is not about the magnitude of the decline, it's about the duration of the decline. And the duration is something that still we're going to be guessing at, because while we're seeing the end of we're seeing the peaks of the virus cases, we aren't yet clear on, as business reopens and as the economy reopens, that's going to be a messy process, and it'll probably be a little bit inconsistent, and that could bring more uncertainty in. So I don't think we're out of the weeds in terms of clarity anywhere near yet. And again, uncertainty breeds fear in the market, so it could be bumpy, but I think we're coming out of it.
But just to add to that point, and you're right about it's not about the magnitude, it's about the duration. And I think we've got, on the policy front, we've got enough tools between the federal government and the Fed to manage a 2 to 3 month disruption, of severe disruption, where people are locked in their homes and economic activity is a fraction of what it used to be. We can survive 2 to 3 months. And I think that's why the market over the last 2 weeks has been getting so excited, is that there's plenty of signs in the market and in the data that this probably will be, a 2-month event of a severe lockdown. There's not much of a need for it to go longer. And we've got the policy tools to address that and get us through to the other side. There'll still be some economic damage, but you're not going to have the large waves of bankruptcies that you saw in the financial crisis, if this is a 2-month event of the severe lockdown. And that the data is starting to point to that, and that's why the market is a little bit more excited in the last 2 weeks.
Right, great point. Thanks so much. Okay, so one question was on the oil stocks and the real estate investment trust. So first of all, I don't want to call them oil stocks. I shouldn't have said that. I should have said energy stocks. So the energy stocks that we have are companies, for the people who have K1s, they're Enterprise Products, Magellan Midstream, Energy Transfer. For the people who don't have K1s, it's Williams, ONEOK, Kinder Morgan, and then everyone owns Chevron. Chevron, believe it or not, that dividend appears to continue to be extremely safe. And of those other companies that we own, these are the pipeline companies. So I'll give you one specific example. One is Williams. The ticker is WMB, but they transport natural gas. And believe it or not, natural gas demand and supply have remained shockingly stable throughout this period. So they just rent the pipelines. And it is the oversimplification to call them toll roads. But in essence, that is what they are. And they have very limited actual exposure to the price of the underlying commodities of natural gas, gasoline, oil. They are just transportation of those. So as long as the lights are on in my office, that's probably, that electricity is probably being generated by natural gas. That's got to come from somewhere, and it's got to go to the utilities to fire it up. So for what we own in the energy space, I don't only think that what we own is going to be fine, but because it got smacked down so severely, just because the whole energy sector got smacked down, I think that we'll end up really well off on those. Someone asked a question about here, I've got another one on stimulus, but someone asked a question on real estate investment trusts. These, never paint these with a broad brush, right? Because there is a huge difference between a real estate investment trust that owns office property or malls like Simon Properties, which we don't own. We used to own it in the growth portfolio. Greg sold it last December at 150. It's trading at, I think, about $50 a share now. But there is a big difference between those and a company like Hannon Armstrong, which also is a REIT by its corporate structure. So it's real estate investment trust. What they need to own is physical real estate assets. So there's a big difference between companies like those and Hannon Armstrong that does financing for clean energy and carbon reducing emissions projects. So Hannon Armstrong's exposure is to wind and solar fuels. Those will continue to thrive regardless of this environment. So on real estate investment trusts, one of the things that we're starting to explore, and I don't know how far we'll get with this, but are the grocery anchored strip malls, because those will come out of this just fine. We've seen firsthand that grocery stores will continue to thrive. But there's just huge differences. Like, there's hotel REITs, there's public storage REITs. So, if you get a storage unit, there are REITs like those. So that's just a broad brush kind of question. Hang on for 1 sec. I just got another email one in about the stimulus. Shoot, where'd it go? Hang on, this is from Gary. Hi, Gary. So it says, I'm very concerned about the rollout of the stimulus will be too slow and also not reaching the bottom tier, resulting in a lower recovery and second round of lower markets. Greg, you want to take that one? Do you mind?
Yeah, I mean, I think the stimulus checks are going to go to everyone in the lower tier. I think the lower 90% of income earners are going to receive the was it $1,800 per
$1,200
per couple. Yeah, that's right, $1,200. Sorry. So they'll receive the bulk of the stimulus checks. I think if you look at the economic data, those income groups spend on average about 100% of their income. So there's a reasonable chance that those stimulus checks, when the economy is open and they're able to spend, that money will get spent, as opposed to when you give stimulus to the highest 10% earners, they tend to save about half of the money coming in, and so that doesn't really have much of an impact on the economy. So this is one stimulus plan where I feel like, at least on the consumer side, the money's going to go to the right place and help people. Today, we just added, just to get to, that may take a couple of weeks for people to still get the money. Cuomo announced in New York, and I believe other states are doing this as well, that they're going to add a $500 payment to anyone who applies for unemployment insurance. So that will hit people. And the idea is that that money will get to people quicker. And those are the people who are in most need. So there's unemployment benefits, stimulus checks coming. Businesses have, I think the best stimulus of all is the SBA loans, which will prevent companies will encourage companies to not lay off workers. So people not losing their job is probably the best stimulus we can have for the U.S. economy. So I'm less concerned about the timing of it, as long as this remains a 2 to 3 month event and the economy starts to get back to normal in whether it's June or the summer.
Yeah, I agree. I think while it might not be as fast as we all want it to be, it's not hitting the bank accounts this week. I think if it hits the bank accounts in 4 weeks or 5 weeks, I think it'll still be okay. Greg, we just got another question from George asking about the pipeline of therapeutics. So this was discussed on this Scott Gottlieb call that we were on this morning too. And what he was talking about is that there's not 2 in the pipeline, but there's not 100, but there are 4 to 6. Maybe I'm confusing this one with the Dr. Fauci call that I listened to. But there are 4 to 6, and they have a lot of promise. Do you have more on that? I know there's the Gilead product, right? There's Mylan.
Regeneron has a product, and then there's some other virus drugs that are in the market already. The hydrochloroquine, which is for malaria, and some others. The key, Scott Gottlieb, the former head of the FDA, was talking about today, was that the key is for the FDA to fast track the drugs where we have manufacturing capacity to produce them. It doesn't make sense to spend money or to fast track drugs where, even if it's approved, we're not going to be able to manufacture enough to make a difference, in the next few months after approval. So there's a lot of drugs that they're working on, and we just have to wait. It's painful to have to wait for the data, but it's a slow process to make sure that the drugs are not only effective, but are also safe for consumers.
But Gottlieb still said this morning that he fully expects, this is interesting. This is from the Gottlieb call too. He said, I fully expect those therapeutic drugs to be available, and tested by the summer and working. But he also said, when people are back to work, and Greg was good to point this out after our call, that it wasn't if people are back to work, but when people are fully back to work in July and August. So Gottlieb, who I think really has one of the best handles on this, truly believes that we're going to be back to work in a normal way by August. Hold on, George has a follow-up. I'll say this too. So, oh my goodness, everyone has questions. Can he address which? No, we can, George. We can't address which have promised because unfortunately we don't know more than what was I gonna say? We don't know more than Scott Gottlieb does. Okay, so another. I think at this point I'm not getting more email questions. If you guys want, please go ahead and hit *6 if you'd like to take yourself off of mute, or if you've dialed in or if you've videoed in, just click in your face. I think it's the upper right hand corner, and you can unmute yourself. And please don't be shy to ask a few questions. Oh, I see Tracy leaning forward. Going in for the kill, Tracy? Uh-oh, you're still on mute. Hold on. Okay. Tracy, did you have a question?
No, I just
Okay. Anyone have any questions? No? Okay. Well, maybe the emailing works.
Jenny?
Yeah? Hi. Yes.
Can you hear me?
Yes.
Oh, good. My concern is, unless there is some way to address this virus, because I think it's going to be around for a while, that the folks are going to be quite cautious in terms of about going to work. I still think, unless one of the drug companies come with some kind of therapy, there will be consequences in the future.
No, that's
What's
for
your
sure,
feel?
George. So that's for sure. So this is what they're saying on these calls. And you know what? I'm happy to email around the replay of the Scott Gottlieb call where he's talking about this. And what he's saying is that he does expect that there will be functional therapies by the summer. I just don't know if it's the Regeneron one, the Mylan one, the Gilead one. I don't know which of those will come about. But he's saying, he's being very realistic, that until there's an actual vaccine, which will not be here before, I believe, at the earliest January, until there's an actual vaccine, it will not be life as normal, right? It might be, and this is what they were talking about on the call too, that it might be a restaurant that holds 500 people, and that's cut in half. It might be that people are wearing face covering devices, also known as masks, into the offices. It might be that offices are bringing back half the people. And so it won't be until the vaccine is there that we'll be back to normal. But a lot can, and this goes to testing and surveillance and all of that too. If you can start to test people and know that they have antibodies and that they're not carriers, like they can go back. So it has to do with testing, it has to do with drugs, it has to do with surveillance. But I'll shoot around to this whole crowd the replay of this call when I get it, because it was great, and they'll do a way better job than we will on the drug front. Any other questions? Okay, so don't be shy to email us, please. Don't be shy at all. And we're always here for you. Well, I think this week, I'm not sure if I'm going to send out an end of week note like I've been doing, because the quarterly letter will be out instead. But hopefully, if it's not, I'll send out a note instead. But it does look, at least from the portfolio perspective, like we're on the mend a little bit. And just to leave on a happy note, the market right now is up 3% on the dividend income strategy on those stocks, and we're up 4.5%. So with that little glimmer of light, I will leave you for this week. And we will talk to you guys next week. We'll do same place, same time. And that's it. So happy Passover, happy Easter. We celebrate both. So I'm making a very lame Passover dinner Seder tonight. Yeah, and then I need to find a ham for Sunday. So that should be fun.
Yeah.
Oh.
Very good. Very good.
Yeah.
Happy holidays. Thank you, Jen.
Thanks. Thank you all so much.
So
Bye-bye.
who's reading from the Haggadah?
Okay, it's the children's Haggadah that we actually used when I was a little kid, that I found when I was like cleaning out a cupboard last weekend, and I was so psyched to find it. So I think I'll let Jack read, since he's the youngest in the family.
Oh, good. Yeah, that's
Yeah.
the way it's supposed to be. Okay, very
Yeah,
good.
the kid. Oh, wait, one last thing. Sorry, Jack is awesome. Jack's 11 years old. This kid is so cool, and he actually made matzah yesterday. I left yesterday. I'm like, hey Jack, can you find a matzah recipe and make some? And Brooksy's making the haroset tonight, so so it should be fun.
you have to learn how to make simmus, Jenny.
I don't even know what that is.
No, well, look it up. It's very
Okay, I will. Or you can send me a recipe.
Happy holidays.
Thanks, everyone.
happy holiday. All right,
Thank
bye-bye.
you. You too.
Bye-bye.
Bye.
Thanks so much, everybody.